Hello, Dr. Tim Creel here. I'm going to talk a little bit about Chapter 11. Go ahead and pull up the presentation. Okay, so Chapter 11, this kind of deals with the audit timeline, one of the subjects that it deals with. Um, so some things to remember, the date of the financial statements would be the year-end date. So whenever the fiscal year end, it might be a traditional year end like December 31st. It might be a fiscal year end, which would be like June 30th. It really depends on the company. So that would be the date of the financial statements. The date of the auditor's report would be the date that all audit work is completed. So once that they've wrapped everything up, they've done um, all their testing, they've had the quality review of the audit by the quality partner, then basically that would be the date that all audit work is completed. The audit report release date, the audit report this is the date that the audit report is released to the public, and it's usually a few days after the date of the audit report. Now, roll forward audit procedures here. This would roll interim work forward to the end of the year. So this would be kind of something when you're working on an audit, if you're doing interim testing on it, if you're, let's say it's a traditional calendar year, the same as the fiscal year. And so you come in at the end of June, and as of June 30th, do some testing over the first part of the year. So roll forward audit procedures would be what you would do to kind of roll that, what you found at June 30th, forward to the end of the year to December 31st. Now, analytical procedures, also, they're used during the planning stage, part of substantive procedures, and for audit review. So analytical procedures, like an example, would be like common size financial statements or vertical or horizontal analysis of financial statements. You would look at, okay, how have things changed from the prior period? Or how are things changed versus the budget? And if you had differences over kind of set amounts, like outside of a normal difference, then that might indicate an area for you to look at in the audit. That's very much how it's used for planning. Now, as far as substantive procedures, it would be used in a similar way, but it would not be the only evidence. It's not really that good as it's not good necessarily as using that as your only form of evidence to support or not to support something. It would be part of the evidence, but not the whole evidence. And also, again, for audit review, when the quality partner in the audit in the firm is looking over the audit and kind of going over it at the very end to see if there's anything that was missed or anything that the quality audit partner would suggest that they go back over, then big thing they're looking at is analytical procedures. How have things changed? If we had an increase here, was that looked at in the audit? If we had an unusual decrease here, was that looked at in the audit? That's a big part of the quality review of the audit that the quality review partner is doing at the end once things have been completed. Now, review of accounting estimates. Again, you're going to go back over estimates, and the big main thing, kind of like we talked about in the last chapter, are they reasonable? Are all estimates reasonable? And that, like I said, that's probably the biggest thing you're looking at as an auditor in terms of estimates. And attorney's letters. You're going to get letters from the client's attorneys that just discuss all pending litigation for contingent liabilities, and it's kind of actually part of the decision process. The opinion of the attorney's letters, kind of part of the opinion process that either supports basically the client's view as far as contingent liabilities in terms of lawsuits, or you might want the client to take another alternative or do something else based on what you find from the attorney's letters and contingent liabilities. Remember, with a contingent liability here, with a lawsuit, for instance, if it's probable that the company is going to lose the lawsuit and it can be reasonably estimated, the company needs to go ahead and recognize a liability and an expense for it. Now, if it's probable but not reasonably estimated, the company just needs to discuss it in the notes to the financial statements. If it's remote, if it's a remote chance that we're not going to lose, this is remote, it's probably going to be thrown out, then the company really doesn't have to do anything. So part of this would be making sure that the company is handling this situation in terms of contingent liabilities properly. Now, completing the audit. Written representations from management addressed to the auditors. And this would be something you would get from management, and it just confirms certain matters and other evidence obtained during the audit. It's written by the CEO and the CFO. So again, this is just confirmation from management. Remember that during an audit, management is responsible for the financial statements. So this is just a written representation to the auditors and just addresses or confirms certain things that happened during the audit, evidence obtained and things of that nature that occurred. The auditors would need to look at the ability to continue as a going concern. One of the things the auditors are looking at is, can this business continue beyond the following year? And if the auditor is concerned that this business is not going to make it through their next fiscal year, they would report that as a going concern, that they have doubts about this company's ability to continue as a going concern. Now, for most companies, this is not an issue, but think about auditors that maybe audited near the end Blockbuster Video, Radio Shack, Sears. As basically Sears gets near the end, the auditors kind of got to have is this company going to be here next year? And the same thing, I read one time that when we had the last recession, like I think back in 2009, General Motors had 3 horrible years. They had losses of over $80 billion during that 3-year period. And the auditors were very much considering issuing a going concern statement in concerns of in representation to General Motors. General Motors then got a capital infusion from the government, I think about $47 billion, and then was able to file bankruptcy in the following year and readdress their debt situation and work their debts into a workable numbers. And ever since then, they've continued to do pretty well, actually. And today, doing fair, profitable organization, making money, kind of like, but they had some struggles there for a while and really were kind of pulled out of it with their reorganization and bankruptcy. So that is something that auditors do have to consider, and they'll actually put that in the audit report if they do not feel the company is a going concern. If there's going concern issues for the company in the following year. Adjusting entries in financial statement disclosure, the auditors would basically make sure that adjusting entries were proper, and that anything that needs to be disclosed in concern with the financial statements is disclosed in the notes or on the financial statements. Rollover considers current period effect for misstatement or iron curtain method. So if there are misstatements that are found in terms of materiality, what the auditor would do is a rollover would only consider, okay, how is this error basically, what's the effect on the current period? That would be the rollover method. The iron curtain method would consider not only the current period, but any prior periods. It would kind of almost be rolled forward, or kind of move forward. I know that the terms almost sound different, but those are the meanings behind those terms. So it's an auditor could assume either approach when it comes to misstatements. And are these misstatements material or not? So these would be two approaches they could use in terms of misstatements and of materiality. Are the misstatements material based on the levels of materiality set in the audit? Okay, an audit documentation review. You would go back over everything to make sure, are the conclusions that you've made, is everything documented? All of your conclusions, we pulled this evidence here, we justified their balance here, we redid the bank statement here. You would do all this work, but you've also got to document everything, to where, if you're, remember that audit firms can be audited by the PCAOB. If they pull this, if the PCAOB comes into your firm and pulls this audit, everything's laid out properly. All the documentation is there to follow. And so this is a very important step, because if you are audited again, all that documentation has to be there to support every conclusion that you've made over the course of your audit, to support your professional judgments that you as the auditor have made in the audit. The engagement quality review, again, this would be done different ways. It could be done. It's done, of course, I said, by the quality partner, another partner in the firm that is not the partner responsible for this audit, would review it at the end to make sure that everything has been done, to see if anything has been missed. That would be one review. Sometimes firms will do their own quality review, or have another firm do a quality review, basically just to make sure that everything's been done properly. But that would tend to occur after the audit's done, or the same thing with the PCAOB. That would tend to occur after PCAOB review. That would occur after the audit is completed. This probably, based on completing the audit, more looks at the quality partner and their final examination of the audit. But again, also, like I said, the audit could be reviewed by other firms, by the firm itself, or by the PCAOB, but that would tend to happen after the audit is completed. Okay, subsequent events and facts. Subsequent events occurring between the date of the financial statements and the date of the audit report. Now, there are some rules kind of during this period that typically would be followed by the client and the auditor. And that is, if something major happens between, let's say that the audit, let's say that the year end is December 31st. They have a traditional year end. And let's say that the audit will be done typically, like I said, within a couple of months. So let's say by the end of February or early March. And so in this case right here, what if around the end of January, they have a major disaster or a major fire and they lose most of their inventory? Or maybe a lawsuit that was up in the air is settled. There are some situations when the auditor would require, if it's a subsequent event that directly affects something from the prior year, the auditor could have the client either show it in the notes as of the end of the year, or could them actually have to restate something with the financials to show that this has occurred. And it would depend on the situation. Typically, if it's something like a major fire or something major, like a major inventory loss or something, typically the auditor might require the client to put it in the notes. If it's an event that was on the books as of last year, like a lawsuit, but it's settled, then that might be a case where they might need to include that in with their financial statements. It's just kind of making sure that everything is a clear picture of the company's financial standpoint as of both the end of the year and before the audit report is completed. Now, subsequently discovered facts that become known to the auditor after the date of the audit report. This is kind of different right here. A little bit different, but it's something that the auditor would also have to consider. There could be some instances where the auditor discovered something and might have to go back and kind of refactor in some of their audit. If they discovered something, oh, we didn't know that, but it comes up, after the date of the audit report, they might need to restate the audit report if it would be something that the auditors missed, for example. So It would depend on the situation as to how the auditor would have to handle it. If it wasn't anything, if it wasn't anything material, it really wouldn't matter. If it was something that was not material, it wouldn't matter as far as the audit report. If they found out something, but it wasn't material, it wouldn't matter in terms of the audit report because materiality is an important factor here. But this is something that the auditor would look at to see is if it's material, is it something that they've got to go back and, you know, change their audit report? Again, something that they would have to look at. A dual date. Sometimes what auditors will do is do a dual date. So they'll give the audit report 2 days, 2 dates. The audit report date, except for the following situation. And what this does is if you had to go back and restate something on the audit report, you could open yourself up for, like, if you did it initially at the beginning of March, but you had to go back and do it again in June, for example, and redo something on your audit report due to subsequently discovered facts. If you do a dual date, you would say the audit report date, except for the following, and it would only hold you liable or possibly any liability for the event that you're changing or you're going back and updating for beyond the date of the initial audit report. It would take away, you're saying, okay, the audit report is good for everything. The audit report date is good for everything except for this situation. And it wouldn't open you up to additional things if something came out between the end of the year and the audit report. So you wouldn't change the audit report date to June. You would just keep the original date except for this situation. Again, it would just help protect you if something else were to come out as an audit firm. Omitted procedures. You would look at any procedures that you might have omitted when you were doing the audit. Part of this would be part of the quality inspection from the quality partner, the other partner we discussed a moment ago. But you would look at were any procedures omitted during the audit. And kind of a rule of thumb here is if you find that you did miss some procedures, but you go back and do those procedures and you find that it would not have changed your opinion, then you're fine. You don't need to do anything else here. But if you find that they would have changed your opinion, then you might have to revisit the audit. You might have to go back and revisit your audit report. So it just does depend on, were they material? Or did you do other things that compensated for them in the audit? These would be kind of things you would look at as far as omitted procedures. Communication with individuals charged with governance. Typically, the auditors will meet with the audit committee. Remember, the audit committee is at least 3 individuals. At least one has to be a financial expert, and they're kind of an independent part of the board of directors that acts as kind of a go-between the company and their external auditors. And sometimes they work also with internal auditors within a company as well. So the basically they would talk about matters with them, such as what was the auditor's responsibility in the audit, overview of the audit and how they did the audit, any issues with the audit that were maybe unusual, any disagreements with management, such as if the auditor said this needed to be done this way, but management refused, or they had a huge disagreement about it, any uncorrected misstatements or any material corrected misstatements. They found something material, but management did make a correction. And this is just kind of an overview of some things, but there are, other things too. Really, they would just discuss the audit in general, how they did it. How did they get along with management? Did they have disagreements? Did they find anything that management corrected? Did they find anything that management did not correct? They would just really go over, and this is just a good kind of sample of a lot of the things that they would probably go that the external auditors would go over with the audit committee. And then finally, the management letter. This is something that the auditor does, and it's kind of a list of some possible recommendations to the client to improve performance. It's kind of, since the audit firm works for the client, this is just some suggestions that might help them improve their business, such as improving their operations. It might be something to do with how could they improve their information systems? How could they improve their financial reporting? How could they improve their ability for error correction, or, you know, it would be just different types of these are some ways you could possibly improve your accounting or different aspects of your business. That would be part of the management letter. It's kind of I've heard it called kind of putting a cherry on the sundae, kind of or something, like that, putting uh, to give to the company that you've been auditing. Not only you're doing their audit, but you're also going to give them some recommendations that might help their business. It doesn't. It's a good thing, and it does really help, I think, build that kind of auditor client relationship. That's I think probably the biggest plus of it. And that is all for chapter 11. Thank you and have a great day.